So this is a range in price delivery where one side of the market liquidity is offered and typically confirmed with a liquidity void on the lower time frame charts in the same range of price. Right, that's how he explains it. If you look at the chart on all the highlighted areas, you realize that there's levels, or these are areas where there was no price action between the last previous high and the next candle's low. So we call this a fair value gap. We call it a gap because it's like the market gap to the upside. So you'll realize that when price did this at a later stage, remember we identified the mean threshold of this level as a sensitive area. So price came back at a later stage and tested the mean threshold of this level here and then continued on the upside. So this is how you identify fair value gap. Another example, we have this right here. We look at the last candle. We look at the previous candle before the one we are looking at, and the next candle's low that comes after the candle that we are looking at. This right here is our fair value gap. So if we are to extend this to the right, you'll realize that price did come back to this area. So what price tends to do is price would use this levels here, the fair value gaps, to find support levels and go to the upside, or price will come back to this level to fill up this and just continue on the downside and find support on a much lower level or point of on a price action tool like an order block or a propulsion blocks, right? So this one has not been identified, but if you look at this one, you look at this up candle and then you look at the previous candle's high and the next candle's low, you realize that they left a gap here. So price came and the low of the next candle, we identify this level as a support level, so it's sensitive. So what price did is they came and they tested this level and went on the upside. So this on its own is a trade, and then they came at a later stage to fill up this gap too and found support on the low of this fair value gap and continued on the upside. So we can utilize this as a trade. And then if we jump to the next fair value gap, which is this one over here, you'll realize that price did come back to fill this gap. So price tends to come back to those gaps and just fill them up, or just find support on these gaps and continue on the upside. If we are on a bullish scenario, we have another gap here. They came to fill. Look at this. So imagine you were in a scenario where you are looking for this order block here to go long, but what price did is they just came to this fair value gap and they found support there and continued on the upside, which means your order was not filled. But if you have knowledge about how fair value gaps works, you'll be able to frame an entry here and continue on the upside, right? So that's how you will do it. And then we have our next fair value gap here. Price came and then found support on the low of this fair value gap. Usually the most probable fair value gaps are the ones that are coupled with an order block or a bullish order block next to them. So if price comes here and then you have confirmation that they're gonna come to fill this fair value gap, and then they might find support on this bullish order block, that's a high probability trade. You look for longs here and continue going on the upside. So let's do the environment or bearish scenarios, right? So we have this gap here. So what price did is they gapped down, but they came at a later stage to fill these gaps here. And then we have another one here. So with this one, they came to fill it up and then find support on this candle here. We'll call it the bearish order block. We just count these 3 candles and we turn them into one, and then when price comes to this level, they find resistance and continue on the downside. Then we have another one here. What price did is they came, then they found support, they found resistance on this fair value gap and continued on the downside, right? And they still came back at a later stage, but this time around they utilized this order block. Remember, we look at the one with the most range, and they came, they found resistance here and they dropped, right? Even though they still continued on the upside. So another gap here we got here. So another gap here, price went down and then left this gap here. Price came back at a later stage, but they did not only fill the fair value gap. What they did is they filled the fair value gap and found support. They found resistance on this last up close candle, which is the bearish order block, and continued on the downside to take out this previous lows. And then we have a similar scenario here. They came, then they found resistance on the midpoint or 50% of the range of this gap, and then continued on the downside. We have this here. The price remembered that there is a gap here, and then they came to fill it up. So an insight: when we utilize fair value gaps, we either utilize fair value gaps for entries, 1, we utilize fair value gaps for exits, 2, we utilize fair value gaps for directional bias, 3. When you talk of directional bias, is where exactly is price likely to go from here. So when we identify a gap, we'll be able to come up with a bias to say this is where price might go to. And then so that's how we utilize the fair value gap, right? Just go into your charts, try to identify this price events or patterns, and see how you can utilize them in your trading journey.